Hi everyone, welcome to our presentation. My name is Naomi and I'm here together with my team, Jeff, Alyssa, Maxine and Karan. We'll be exploring whether firms today prefer staying private rather than going public. This discussion is based on Rajagopal's Forbes article, Have Reporting Burdens Led to More Firms Staying Private? We'll discuss how the complexity of consolidated financial reporting, the cost of SOX Section 404 regulations, the reporting environments in Australia, and investor perspectives have all influenced this trend. With that, I'll pass it on to Jeff to first introduce the complexity of consolidated financial reporting.
Hello everyone, I'm Xin Wang. Let me talk you through the complexity of consolidation financial statement. First of all, control should be recognized to determine whether the parent company really has control over the subsidiary. It's also necessary to consider a number of factors, such as the parent company influence on the board of directors' decision-making, operating policies, and the proportion of equity, in particular indirect shareholding. After control is recognized, fair value adjustments have to be made to the assets and the liability of the subsidiaries, especially in the case of intangible assets like brand value and customer relationship, which can be both difficult and subjective to access. Goodwill has to be recognized if the acquisition price is higher than the net asset value, and impairment tax have to be carried out on an annual basis. In addition, all internal transactions must be eliminated to prevent double counting of profit. For example, profit from the transfer of inventory and equipment need to be tracked to their subsequent sale. The financial statement have to be adjusted from scourge for each financial circle. The workload is very heavy. This cope with compliance requirements such as SOX Section 404, which require detailed disclosure of internal control assessment and audits, and separate audits of each subsidiary within the scope of the consideration statement of operation, has significantly increased the financial and administrative burden on companies, and has directly contributed to many companies choose to remain private or seek private equity buyouts in order to avoid the stringent disclosure requirements and high compliance costs of the public markets.
Thank you, Jeff. Now let's take a look into SOX Section 404. So in 2000, Enron's revenue soared by $87.4 billion in just 4 years. But in reality, Enron was transferring its debts to its other subsidiaries in order to inflate its own profits. When the fraud was exposed in 2001, shares dropped to just 26 cents, causing investors to lose out on billions. As such, this exposed major risks in corporate accounting practices for firms with complex group structures in particular. In response, Congress enacted the Sarbanes-Oxley Act of 2002 to reduce fraud by enforcing stricter reporting methods to safeguard investors and restore public confidence. However, Section 404 has been heavily criticized as it targets public companies, mandating that they 1. Establish and maintain internal controls over financial reporting, and 2. Assess and disclose their effectiveness. This includes seeking an attestation from an external auditor, which will naturally increase auditing costs for companies. Complex structures occur when a parent company owns multiple subsidiaries or operates across borders. SOX Section 404 applies at a consolidated group level, which makes compliance especially costly for complex firms. Iliev argues that SOX Section 404 regulations increases audit fees by at least 167%. It is expensive for complex groups to consolidate auditing and ensure checks across all of their diverse and often global subsidiaries. This is because subsidiaries across jurisdictions use different financial systems and follow different internal processes. Integration is therefore particularly difficult for newer entities or those who have yet to implement modern systems. Implementing SOX controls often disrupts operations and increases labor costs, as the controls need to be continuously managed. As such, public companies, particularly complex firms, face greater pressures than private ones, therefore deterring firms from going public in the US altogether. The inherent issues of Section 404 pressured the Public Accounting Board to implement the Auditing Standard No. 5 in 2007. This included the introduction of the top-down risk assessment process, helping to reduce costs by focusing only on things such as material risks and significant accounts, rather than testing every single control in every single entity.
Thank you, Naomi. Next, we shift our attention to a critical trend in the current Australian corporate finance: the increasing preference of many firms opting for private equity acquisition over traditional IPO routes. This preference is clearly illustrated by market activity. As seen on the graph, EY in 2024 has stated that 21 Australian public companies turned private in quarter one alone, signaling a strong and consistent shift. Why is this? So, specifically, we need to understand from a consolidated accounting perspective, how does the reporting environment differ between PE-owned firms and public companies for Australian firms? The article did highlight that public firms face a reporting burden premium, which may be a major driver for the shift. So let's examine the key differences between the two in detail. For public companies in Australia, the consolidated reporting environment operates under a transparent and highly rigorous consolidated accounting regimen. Regarding their consolidated requirements, it is mandatory and comprehensive. They're required by ASB 10 to prepare full consolidated financial statements for public dissemination. In terms of their disclosure and reporting frequency, this is frequent and extensive, including annual and half-yearly reports, continuous disclosures under the ASX Listing Rule 3.1, and public discussions at AGMs. For regulatory oversight and governance, there is high scrutiny, regulated by both ASIC and ASX. They would face formal governance structures and strict requirements for board compositions and internal controls. Their disclosure requirements are broad. They must disclose extensive details, including ASB 8, ASB 124, ASB 9, ASB 13, executive remuneration details, significant accounting policies, and a sustainable reporting. Finally, their audit obligation: they must face mandatory and extensive public audits, often including internal controls and documentation. This now Alyssa would take over for the PE-owned firms.
In stark contrast, for private equity-owned firms, the consolidated reporting environment offers significant advantages in terms of flexibility and reduced public scrutiny. Firstly, while ASB 10 requires consolidated financial statements when proprietary company controls subsidiaries, private firms may benefit from certain relief provisions. This provides structural flexibility in how financial relationships are reported. Second, the disclosure and reporting frequency is much lower compared to listed entities. Large proprietary companies typically file only once per year with ASIC without the need for continuous market updates. In terms of regulatory oversight, these firms are not subject to ASX governance requirements. Instead, oversight is provided directly by the private equity owner or its board, allowing for more strategic autonomy and streamlined governance processes. Disclosure obligations are also less onerous, while large proprietary entities must prepare general purpose financial statements or apply reduced disclosure requirements. Their reports are not widely distributed and are exempted from market announcement rules. Finally, annual audits are required for large proprietary companies, but the audit process often less intensive due to fewer compliance and disclosure obligations. Overall, the reporting environment for private equity-backed firms supports agile financial management while maintaining baseline compliance standards. The streamlined private model offers strategic advantages: greater confidentiality, long-term focus, and lower compliance burdens, explaining why many firms prefer private equity over an IPO. Compared to the heavier public company rule set, the IFRS-compliant private route allows access to capital with fewer regulatory demands and greater operational flexibility.
Thanks, team. Let's now examine the key investment risks when firms operate in private markets with limited consolidated reporting. First is valuation risk. Without full consolidated financials, critical exposures like intercompany loans or contingent liabilities remain hidden. Rajgopal shows how limited data increases pricing uncertainty and makes fraud detection substantially harder, particularly in private equity deals, where internal reporting lacks external benchmarking rigor. You're making million-dollar decisions while essentially flying blind. Second is governance risk. Private firms aren't bound by ASX listing rules or public accountability frameworks. There's minimal independent oversight, no continuous disclosure, and limited transparency around board processes. The absence of SOX 404 style internal control further reduces protection. Liev demonstrated that mandatory internal control audits delivered measurably better earnings quality in public firms. You're trusting management to self regulate until it fails, and you're the last to know. Finally, liquidity risk is substantial. Private equity stakes can't be easily sold, with typical hold periods of 5 to 7 years or even more, and exits dependent on negotiated deals rather than market pricing. When you want out, there's no market, just whatever deal you can negotiate. So why stay private? The efficiency benefits are clear. AASB 10 allows fewer disclosures, no ASX compliance, and dramatically lower regulatory burdens. But investors bear the cost of opacity through high information asymmetry, reduced governance transparency, and constrained liquidity. Rajgopal calls this the cost of opacity. Liev found public firms paid $700,000 extra for SOX compliance but gained measurable reliability. Evan Xiao and Xu estimate compliance costs at 4.3% of market cap expensive, but providing valued investor assurance. As regulators debate easing listing rules, we must weigh this carefully. Private markets run leaner, but investors operate in the dark. The question isn't whether private markets work. It's whether investors are adequately compensated for the transparency that they surrender.
In summary, the detailed and costly requirements involved in consolidated financial reporting have a significant impact on companies' decisions to remain private, particularly those with complex organizational structures. Regulatory demands, especially those under Sarbanes-Oxley Section 404, further add to these pressures, promoting many firms to prefer private equity ownership, which offers more flexibility and less regulatory oversight. While private ownership can offer strategic benefits such as confidentiality, operational flexibility, and reduced compliance expenses, it also poses significant investor risks, including uncertain valuations, less transparent governance, and limited investment liquidity. Investors must therefore carefully consider these trade-offs, conduct thorough due diligence before engaging in private market investments. On behalf of my team, thank you for watching our presentation.